Thanks, David. Great to be with you. Well, like many entrepreneurs, I think I got into this business totally by accident. So it was the summer of 1979. I had just finished my first year of law school, and I had this great opportunity to do some good work and to see a new part of the country. So I moved from Memphis, Tennessee to Worcester, Massachusetts, where I worked for a group of pension lawyers. So the law that created ESOPs was implemented in 1974. This was 1979, so the law is only 5 years old. And the lawyers got a letter from one of their clients asking for a white paper on ESOPs. And so all of these gray haired, very experienced pension lawyers looked around at each other and they all said, I don't know anything about ESOPs. And the result was they decided to give the project to the kid. And in 1979, I was the kid. So I spent that summer reading and writing about ESOPs and then graduated from law school in 1981, passed the bar exam that summer, and went straight into this business. So I kind of stumbled into this by accident, but it was a very fortuitous situation. Yeah, it's really two things in one. And so for a business owner, an ESOP is a liquidity strategy, a way for the business owner to cash in on their life's work while at the same time handing the business off to their employees. And so it is a liquidity and succession strategy like a sale to a strategic buyer or a sale to private equity might be alternative to those two liquidity strategies. From the employee's perspective, an ESOP is a retirement plan. So it's a first cousin to a 401k plan. But an ESOP has three differences as compared to a 401k plan that allows it to serve these dual roles, a succession and liquidity plan and a retirement plan at the same time. So the first difference is unlike any other type of retirement plan, an ESOP can borrow money. The second difference is that an ESOP can engage in certain transactions with parties in interest. So that's a legal term, and I'll come back and explain what that means. And then the third difference is that an ESOP is required to invest primarily in the stock of the sponsoring company. So, as a practical matter, what happens is that an ESOP borrows money. Part of that comes from a bank, and part of that comes from seller notes, an IOU between the company and the owner. It then uses those two sources of capital to engage in this transaction with a party in interest. And in plain English, what that means is that the ESOP purchases stock from the company's owner or owners. I mean, we've had anywhere from one to about 60 people sell to ESOPs in the past. Then, once that stock has been purchased by the ESOP, it is then allocated to participants' accounts over a period of time. And that might be somewhere between 20 in 40 years, shares are allocated to participants, and that's how it becomes a retirement plan. So there is something in this for the company's owners and for the employees. Yeah, well, one thing is I just got off a Teams meeting with a business owner in Southern California, located not too far from where you sit. And they had just been frustrated going through the process of dealing with the investment banking, private equity, exploratory process. There were lots of things about it that they didn't like and just were desperate to find an alternative. And so that's one motivating factor. Another is there are some business owners out there that I call compassionate capitalists, people who want to do well for themselves and their families while also doing well for others. And often those others that they're thinking of are their employees who help get them to the point where they can have this successful financial transaction. So an ESOP, unlike a sale to private equity or to a strategic buyer, gives a business owner to take care of themselves, receive full fair market value in this ESOP transaction, while at the same time selling the company to the employees, with that sale being financed by the company with a generous tax subsidy provided by Uncle Sam. And so, for those business owners who want to protect and reward their employees and not subject them to the uncertainties that come when you sell to a third party, an ESOP offers that alternative. Yeah, 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 yeah. So I've got this thing that I call the greed scale. And on one end of the greed scale is Mother Teresa, who gave away all of her possessions to take care of the poor. And on the other end of the greed scale is Gordon Gekko. And so, in order to be a good candidate for an ESOP, you don't have to be Mother Teresa. You're going to be able to take care of yourself and your family and get full value of the for the company. But you can't be Gordon Gekko and only be focused on yourself. You have to be more of a compassionate capitalist who wants to take care of themselves, but is thinking beyond themselves and thinking about other people. Yeah, that's exactly right. Um, Legacy and culture are two additional things that draw people to ESOP. So we've got a client in Texas that when we did the ESOP, the company was 104 years old. And the business owner said, look, there has been a business in Dallas, Texas, with my family's name on it for over 100 years. And I'm committed to making sure that continues. And I know if I sell to a third party, that's not going to happen. And so that was his motivation for doing the ESOP was really focused on legacy, but it was also focused on maintaining company culture. And he was a wise gentleman, and he knew that if he sold to a third party, they were going to tell him, look, after the sale, nothing's going to change, but everything changes. And legacy of his company becomes the legacy, or the culture of his company, rather, becomes the culture of the acquirer. And that's not only detrimental to the company's employees, it's also detrimental to their customers. I mean, they're successful in their business because their customers are accustomed to being treated a certain way. And if that changes, it's not good for business. Speaking of the way you're treated, I think the best example is a shopper who walks into Kroger versus a shopper that walks into, um, uh, gosh, what's the big upscale grocery store chain based out of Florida? Uh, yeah, the experiential difference is incredible. You know, on one hand, you're treated like a number, and on the other hand, you're treated like a person. Yeah. Yeah, and one of the keys to having a successful ESOP is communicating to the employees what the ESOP means for them. And so, with an ESOP, everybody's interests are perfectly aligned. All of the employees are going to get a salary and a bonus. That bonus is going to be based upon short term performance. And then on top of that, they're probably going to continue to have their 401k plan and, in addition, have the ESOP. And the long term performance of the company is going to determine the value that they receive from that ESOP. So if a company grows at 5% rather than 2.5%, then the employee is going to have twice as much money in their ESOP account as they would otherwise. So you really get that alignment of interest where we see all of the employees in the same boat, rowing in the same direction, trying to make the company better and more profitable for everybody because it's going to benefit them and their families. Yes. Yes. And you talk about engineering firms. Historically, that's been our biggest market. We've done more than a dozen ESOPs for engineering firms. And I think there are two key reasons for that. The first is owners know that the success of an engineering firm is totally based on the company culture, and they want to be able to maintain that after they leave. I think the second reason, and one of the disadvantages of ESOPs, is that they are complex, but that's an engineer's life. That's what engineers do, is solve complex problems. So you don't have the fear factor with engineers that you sometimes have with others, because they relish the complexities where others run from it. In terms of financial metrics, you need to have at least 35 employees and at least $2 million of adjusted EBITDA. Uh, because of the complexity, ESOPs are expensive to implement. There are at least three sets of lawyers involved in every ESOP transaction, so sometimes more. And so ESOPs work best for mid-size to small companies, not for micro companies. You need to have at least a couple of $1 million of adjusted EBITDA to be a good candidate, and you need to have at least 35 employees. And so those are two of the key qualifiers. And then in terms of softer types of qualifications, companies where the owner is interested in legacy, maintaining culture, rewarding employees, aligning their interests, some of those things that we've already discussed. The rule says substantially all of the employees. So those are people who work full time, which is defined as 1,000 hours a year, have been with the company for at least a year, uh, are receive a W 2, not a 1099. Uh, there are some of those requirements that could eliminate some of the people from participation, but most of them participate. But they don't make an election as to whether or not they want to be in the plan. It's not like a 401k plan where I have to make a decision to contribute my money in order to qualify for the match. With an ESOP, everybody is in the plan that meets those qualifications, because the company's paying for everything. So from an employee's perspective, an ESOP is much more generous than a 401k plan, because in an ESOP, I don't have to do anything in order to get my contribution. I just have to be there and continue to work. And then the harder I work and the smarter I work, the more I'm going to have in my account. The process almost always begins with a conversation or two to help us determine whether or not the company might be a good candidate. And if they are, then they will engage us to prepare a feasibility analysis. So that's the first major step. And in that analysis, we answer the four key questions that they always have. First, if I sell to an ESOP, what would I expect the purchase price to be? The owner needs to know if that's consistent with their expectations. The second thing is, how will the transaction be financed? And so ESOP transactions are financed with a combination of bank debt and seller debt, sometimes company cash. And so the owner wants to know more specifically, how much cash can I expect at close? That's a key issue. And so we're going to provide them an estimate of that. And then they're going to want to know uh, what the seller notes are going to look like. And just by way of preview, since that debt's going to be subordinated to the bank debt, it's going to have an all-in return of approximately 12%. So a very attractive rate of return for the business owner. It's probably going to be their best investment in their entire portfolio. And then they want to know about corporate governance. And the shortcut answer to that is not much changes. There's usually some additional formality that's required, but the owner who sold is going to continue to control the transaction and control the company after the transaction. And then the fourth thing that we look at are stock appreciation rights. So almost all of our clients tell us that all of my employees are important, but there's some employees who are critical. And I want to be able to do something extra for those mission critical employees. And so that's done via a stock appreciation rights plan. So those key employees have their ESOP account. Then layered on top of that, they have a SAR plan that provides them additional incentives. Yeah. Yeah. Well, assuming a company's in a position where it's ready to sell, then it's going to take 4 to 6 months in order to execute the ESOP sale. Yeah, there are several parties involved in an ongoing basis. One of those is going to be the trustee, which is now the owner of the stock. The second is going to be the trustee's valuation advisor. So we're dealing with closely held companies, a price quoted on a stock exchange. So, how are we going to know what the value of the shares is from year to year? The answer is the trustee hires a valuation advisor, and each year the company shares are revalued. So, those two parties are going to be involved. And then the third party is the plan administrator. So, sometimes in the 401k world, we refer to that person or that party as a TPA, a third party administrator. And so the ESOP is going to have a TPA, much like a 401k plan does. And that TPA is going to prepare participant statements so that the participants know from year to year what's in their account and how much of that is vested. And they're also going to do compliance testing and prepare the ESOP's tax return. So those are the three key parties that are involved on an ongoing basis. Yeah, right. Yep. Yeah. Number one is most people assume that if I sell to an ESOP and do what's really in my heart to do, that I'm going to have to make a sacrifice on price. And that's just not the case. Probably 25 to 33% of our clients each year have engaged an investment banker and gone through a process of trying to sell the company to a strategic buyer or to private equity before we ever talk to them. And based on that, they have a number based on pretty informed information about what they think the company's worth. And they tell us, look, if we can't get at least this much based on our experience, then we're not interested. Never had a situation, David, in 44 years, I've never had a situation where the ESOP did not meet their expectations. Every time an ESOP offers more than the best quote or bid that they had ever gotten from private equity. And that is so counterintuitive for most people. They assume that private equity is going to pay more. They think private equity is a more glamorous path. But actually, if you think about it, it makes perfect sense. Private equity is owned by and reports to its investors. And those investors want a double digit rate of return. Sometimes they expect as much as 20% on the money that they're investing. And so if you have that drag on the finances of a transaction, it just makes perfect sense that private equity can't pay as much because private equity is serving two masters. The seller in the transaction, but its primary obligation is to its investors. And the higher the price, the lower the return to those investors. The ESOP doesn't have that. The company is paying for the cost of the ESOP, not an investor who's expecting a double digit rate of return. So it's just perfectly logical that an ESOP could pay more because an ESOP's only serving one master, the seller. It's also looking out for the best interest of the employees, but the employees aren't investing any of their own money. Yep. Yep. Well, I hope our listeners are sitting down because they're going to be surprised when they hear this. Um, if you have a 100% ESOP owned company, that company is going to be exempt from taxation. And so your company is going to operate as a church or a synagogue on a tax-free basis. No tax at the company level because the company is going to be an S corp, and we all know S corps are flow-through entities. They're flowing their income through to their owner. And so if I own an S corporation, then I might pay 40% in tax on that S corporation's earnings. If an ESOP trustee owns an S corporation, that ESOP trustee is a tax exempt entity. So we don't have that 40% tax drag on the company. So the company can afford to pay off the debt that it's used to buy out the owner on a much faster pace because it's not sending 40% of its earnings to the tax man. Yeah. Oftentimes the mentality is I'm an owner and owners don't quit. A couple of things. I think the key is education. People know how the other liquidity options work. Most people don't know how an ESOP works. And so in 2009, I wrote a book called The ESOP Coach. And it's the only book on ESOPs that was written for business owners. So it's in plain language with all of the legalese stripped away. I've found over the years that business owners often learn best via examples. And so there's 6 chapters with case studies in there. And an owner can find a company that looks like theirs and just read a story about that, how that company used an ESOP. So, the book is available on Amazon. The second thing that I'd recommend is go to our website, and there's a link to buy the book there as well. But our website is just full of educational information. And our or our website address is www.execfin.com, EXECFIN.com. And so those will give business owners 2 great resources to learn more and determine whether or not it might be something worth considering. David, thanks very much.